For our final session then in Chapter 18, we have to consider another entity that could be involved in group accounting, and that is known as an associate. Now, we saw the term associate in our very first session for this chapter, but as I promised, we're going to have a look at it in a bit more detail here. Now, an associate is where another company buys 20 to 50% of their ordinary voting shares, and that would be deemed as an associate. So if a holding company buys between 20 and 50% of the ordinary shares, then that entity is deemed to be an associate and is accounted for as an associate. Now, the important thing to remember here is that an associate we do not have control over. There is absolutely no control. And if you remember, we said if we had control over an entity, a subsidiary, we would consolidate. Well, we never consolidate an associate. Why do we not consolidate an associate? Because we do not have control. Because usually you get control by buying more than 50% of the ordinary voting shares in that entity. Well, with an associate, you do not have control, but what you do have instead is significant influence. Okay? Significant influence over that entity. Which means you don't have the power to govern, you don't have the power to tell the directors what to do, but you do have significant influence, the power to participate in that entity's financial and operating decisions. And as such, you are going to be one of the largest shareholders in that entity, but you do not have the majority of the voting rights. So people could still outvote you at the associate entity's annual general meetings if needs be. So as such then, you can participate. You do have significant influence. The directors of the associate entity won't ignore you because chances are you'll be one of the largest shareholders they have as a single entity. So you do have the power to participate, but not the power to govern, and therefore you do not have control. You merely have significant influence. So, looking at significant influence then, IAS 28 explains that significant influence is the power to participate in the financial and operating decisions of the associate, but not to control them. And significant influence is generally obtained by acquiring 20 to 50% of the ordinary voting shares of that entity. So, it's not a subsidiary, we're dealing with an associate now. Now, you can get significant influence in other ways than just having 20 to 50% of the ordinary voting shares. For example, the existence of significant influence is usually evidenced in one of more of the following ways. Obviously, 20 to 50% of the voting shares would be one of them, but there could be others. We could have representation on the board of directors. So some of the directors in the parent may be represented on the board of directors of the associate as well. Well, again, directors are appointed by the shareholders to run the activities of that business. So as such, you would have some sort of significant influence by virtue of having some of your own directors on the board of directors of the associate. If you participate in the policy-making processes of the associate, then that would also deem you to have significant influence. Significant transactions between the investor or the investee, and also any interchange of management personnel between the associate and the parent company. And these would all be other ways that you could get significant influence other than just 20 to 50% of the ordinary voting shares that the parent has purchased. Now, if we deem something to have significant influence, we treat them as an associate. But remember, we do not consolidate an associate in the group accounts. What we do instead is use a method called equity accounting. Okay? So we treat an associate and we equity account for an associate, but you do not add together the parent and associate's results on a line-by-line basis like you do with a parent and a subsidiary. We equity account for the investment. Now what that means is that the investment, the purchase of the shares in the associate, we initially recognise as its cost and show that in the parent company's non-current assets. But then in the group accounts, we will still show the investment in the associate at cost under group non-current assets, but we're also going to show the growth of the investment in the associate post-acquisition. So, let's have a look then at how we account for an associate in the statement of financial position. So, initially what we do then is we value the investment at its cost or its purchase price. Okay? What we then do is add our share, so let's say 30%, of the post-acquisition reserves of the associate. So if the associate has made $100,000 worth of profits after we acquired them, and we own 30% of them, we would take 30% of 100,000 and add that to the value of the cost of the investment. So that would be 30% of the growth in the associate post-acquisition. Cost plus growth will give us the carrying value of the investment in the associate for the consolidated statement of financial position. So just to give you a feel for where this would go, in the CSFP, the group statement of financial position, under non-current assets, we'd have PP&E, parent plus sub. We'd have goodwill, which would be a working for the sub only. And then we'd have a line called investment in associates, which would be the working after group reserves. And that's the working here. Cost plus our share of the growth. Okay? And that's what we would show in our CSFP. Now you'll notice that because we're towards the end of our notes now of this chapter, there is no numerical examples for an associate. And that's because the F3 study guide doesn't say anything about calculating the value of an associate, but merely to explain what an associate is and how we equity account for them and understand what equity accounting is. Cost plus growth. That's all it is. So questions on associates will largely be theoretical. There will be no numerical calculations. And as such, I haven't put any into these notes because there's no need for you to do it. But all I would want you to appreciate is that the investment in the associate is carried as a single line in the statement of financial position as cost plus growth. And that is it. Everything else is ignored for the associate in the statement of financial position. Now, we also may need to equity account for the associate in the consolidated statement of comprehensive income. Well, what we do there is just take our share of the growth in the associate post-acquisition and add it to the parent's profits. So, what we do is we find the associate's profit after tax for the year and take our share of it, 30%. So if I was to do a SOCI extract for the group, and you had the parent, the sub, the adjustments column, and the group column, what you would have then is you would have, gross profit, parent, sub, group. You would then have some other expenses, so admin expenses, distribution costs or finance costs. And just before you get to profit after tax, you add in a line called profit in associate or profit in A, and we would take 30% of the associate's profit after tax, or PAT, profit for the year. Add that to the parents column and to the group. That will give you profit before tax, parent, sub and group, and then you would carry on tax, profit for the year, and then do the split. Remember, it's the parent that owns shares in the associate, not the sub. So all we do is give ourselves our share of the associate's profit for the year. And that's it. So in the consolidated statement of comprehensive income, the associate is ignored except for one line giving the parent their share of the associate's profit after tax. But again, you won't be asked to do this, but merely appreciate that it's just a single line in accordance with equity accounting in the standard IAS 28. So, overall then, what would happen with an associate if you were to do a group structure is you would have the parent who maybe has control in a subsidiary and you would consolidate. An associate you don't control and therefore lies outside of the single entity. Let's say you own 30%. You draw a circle around the group that you're going to consolidate. The associate you do not account for as a consolidation, you equity account. One line in the SFP, cost plus growth, and in the statement of comprehensive income, one line, our share of their profit for the year. And that's it. So the associate lies outside of that single entity concept. Therefore, we don't have control, we do not consolidate. We have influence, and it would be worth you learning how you get influence. 20 to 50% of the ordinary voting shares and those other ways that we saw earlier on. This is largely theoretical, and it is theoretical. There will be no numbers with an associate. So, learn what significant influence is and how we get it, and have a look at the equity accounting once more to see where the associate fits in. But we're done with group accounting then, this new syllabus area in F3. So we'll then move on to our final chapter in the next video. Thank you.